There's a group of about a dozen people who can quietly erase years of your savings without ever touching your bank account. You've never met them. You didn't vote for them. But they just help decide what your mortgage costs, what your groceries cost, and whether your job feels safe next year. I'm talking about central banks. Sounds like boring news backdrop, right? But it's already inside your life. It's in the interest on your credit card. It's in your rent. It's in why your paycheck buys less than it did last year, even though the number on it went up. Here's what almost nobody tells you. Understanding this one mechanism won't make you rich overnight, but ignoring it can quietly cost you tens of thousands of dollars over your lifetime, and most people have no idea it's happening. By the end of this video, you'll see money completely differently. Let's start with the villain nobody's ever properly introduced you to. Meet the thermostat. Every economy has one. In the US, it's called the Federal Reserve. Just like a thermostat controls temperature, this institution controls the temperature of money, how much of it exists, and how expensive it is to borrow. It's not some secret group plotting against you, but it's one of the most powerful forces in your financial life, and almost nobody explains how it actually touches your wallet. Most people think inflation just happens, like weather. Prices go up, we shrug, we adjust. But inflation is heavily shaped by decisions made in one building, by a small group of people, several times a year. It's not the only cause. Energy prices, supply shocks, and government spending all play a role too. But the thermostat is often the biggest lever in the room. Here's the mistake almost everyone makes. They treat their salary as the main character in their financial story. If I just earn more, I'll be fine. But your salary is only half the equation. The other half is what your money is actually worth, and that's shaped by people you've never met, in rooms you'll never sit in. Picture a giant water tank. That's the total money circulating in the economy. The thermostat controls the faucet. Open it wide, and more money flows in. Loans get cheap. Spending increases. The economy feels like it's booming. But here's the twist. The tank got bigger without the economy actually producing more stuff. Same amount of goods, more money chasing them. Prices rise. Your dollar becomes a smaller slice of a bigger pie. Here's aha moment number one. The Fed has never once put what's best for your personal paycheck on its agenda. Its actual job is to keep prices reasonably stable and keep employment strong. Broad goals for the whole economy, not decisions built around any single person. Nobody up there is protecting your personal purchasing power. That job is yours. Let's bust a myth while we're at it. Most people think interest rates are a boring technical detail that bankers argue about. In reality, interest rates are the steering wheel for your entire financial life. When rates go up, borrowing gets expensive. Mortgages, car loans, business loans, all of it. When rates go down, borrowing gets cheap and people take on more debt. Here's a number that makes it real. A $300,000 30-year mortgage at 3% costs you roughly $155,000 in interest over the life of the loan. That same loan at 7% costs you almost $420,000 in interest. That's not a rounding error. That's an entire second house, just in interest, decided in a boardroom you'll never see. Here's aha moment number two, straight from history. In the late 1970s, US inflation hit nearly 14% a year. Prices rose so fast that people rushed to buy cars, appliances, and land before the price tag climbed again. The Fed's response was brutal. Interest rates were pushed above 19%. It worked, but it also triggered one of the sharpest recessions in modern US history. That's the trade-off baked into the thermostat's design. Control inflation, and you risk stalling the whole economy. Ignore it, and you risk it spiraling out of control. So why doesn't any of this feel urgent to most people? Because inflation doesn't attack all at once. It nibbles. A little more for coffee, a little more for rent. Each increase feels small enough to ignore. Psychologists call this temporal discounting. We overvalue what's happening today and undervalue what's creeping up on us slowly. Stack 5 years of small increases together, and your money can lose 20 or 30% of its buying power while your salary barely moved. Here's aha moment number 3, and it's uncomfortable. Inflation doesn't hurt everyone equally. If you're holding cash in a low-interest savings account, inflation quietly eats it alive. But if you owe a fixed-rate mortgage, inflation can actually work in your favor because you're paying back that loan in dollars worth less than the ones you borrowed. That's why savers often lose ground during high inflation, while people holding real assets and fixed-rate debt often come out ahead. Wealthier households tend to hold more property, more business ownership, more stocks, assets that generally track or outpace inflation over time. That's not a conspiracy. It's just how the math tends to work, and it's rarely explained to everyday savers. Now let's raise the stakes with two people. Both earn the same salary, both save 10% of their income. One of them understands how the thermostat works. The other doesn't. When rates are low, the informed one locks in a fixed-rate mortgage before rates climb and puts savings into assets that historically keep pace with inflation, like index funds or property. The uninformed one keeps their savings sitting in a regular account, thinking they're being careful, unaware that inflation is shrinking it every year. 10 years later, the informed person's mortgage payment feels smaller as their income has grown, and their assets have grown too. The uninformed person's cash sat there earning next to nothing, quietly losing real value year after year. Same income, same discipline, wildly different outcomes. And if you want to see what happens when a country's thermostat breaks completely, look at Zimbabwe in the late 2000s, or more recently, Argentina and Turkey, where inflation ran so high that prices doubled every few weeks, and people spent their paychecks the same day they got them, just to buy anything before the price rose again. Most countries never come close to that extreme, but it shows exactly what's at stake when this system fails. So here's what you can actually do, starting today. Before any major borrowing decision, a mortgage, a car loan, a business loan, check where interest rates are and where they're heading. Rates near multi-year lows are often a signal to consider locking in a fixed rate before they climb. Compare the interest rate on your savings account to the current inflation rate. If inflation is higher than what your savings are earning, that money is losing real value every day it sits there. Know whether your existing loans are fixed or variable. A variable rate means your payments can rise every time the thermostat turns up the heat, and that's worth knowing before rates move, not after. And pay attention when central banks announce rate decisions. Markets react within minutes because those decisions ripple into borrowing costs, business investment, and asset prices almost immediately. You don't need to predict every move. You just need to stop being surprised by them. Here's the truth most people never sit with. You don't need to predict the future, and you don't need an economics degree. You just need to understand that the value of your money isn't fixed. It's being shaped right now by decisions happening far above your everyday life. The people who quietly get ahead aren't smarter, and they're not luckier. They just stopped treating the thermostat as background noise. They started watching it. And now, so can you.